Christmas, 1983. Parents lined up before the store even opened, shoving down the aisles, a few of them nearly coming to blows, all for a Cabbage Patch Kid. The one toy everybody suddenly had to have. Well, last week, Wall Street lined up for a frenzy of its own over a brand new chip stock. I'm Jose Martin with LifeCraft Wealth Management, and this is your Monday Market Minute. Here was the hot toy on the shelf, the biggest U.S. market debut ever for a foreign company, a memory chip maker sitting right at the center of the AI boom. Before it even started trading, reports said demand was more than 7 times the shares available. When it opened Friday, it jumped about 13%. Everybody wanted in. And it wasn't just that one name. Chip stocks ripped. One widely watched semiconductor index jumped around 5% in a single day. The S&P 500 and the NASDAQ both finished the week up more than 1%, with S&P back above 7,500. Well, why would a single stock cause that much noise? Because memory chips are the workhorses of artificial intelligence, and this was a brand new way to bet on it. That's a genuinely big story. But notice what it drowned out. Same week, oil swinging on Middle East tension, and traders quietly raising the odds the Fed hikes rates again this fall. Here's something worth holding on to. The loudest headline of the week, and the one that actually matters most to your retirement savings, are very often not the same thing. Over the years, the people I've watched retire well were rarely the ones who caught every hot trade. They were the ones who stayed clear on what their money was for. The travel, the time, the grandkids, the legacy they wanted to leave. When you're that clear, the trade you didn't make stops feeling like a missed fortune. It just looks like someone else's lottery ticket. There's always going to be a hot new toy on the shelf. The question that matters isn't how to get one. It's whether you already know where you're headed without it. Sit with that this week. I'm Jose Martin, and I'll see you soon.